Now speaking, John Sweeney, Vice President, Investor Relations. Good afternoon, everyone. Thank you for joining us for DXC Technology's first quarter fiscal year 2024 earnings call. Today, we have Mike Salvino, our Chairman, President, and CEO, and Rob Del Bene, our EVP and CFO, as our speakers. The webcast of this call, along with accompanying slides, can be found on DXC's Investor Relations website. We will be discussing certain non-GAAP financial measures, which we believe provide valuable information to our investors. Reconciliations of these measures to their respective GAAP measures can be found in today's earnings release and webcast slide. Please note that some of the comments made on this call will be forward-looking and subject to known risks and uncertainties. A discussion of these risks and uncertainties can be found in our quarterly report on Form 10-Q and other SEC filings. Now, let's hear from Mike Salvino, DXC Technology's Chairman, President, and CEO. Mike. Now speaking, Mike Salvino, President and Chief Executive Officer. Today, I will provide an update on our overall business performance, specifically focusing on our GBS and GIS businesses. Our goal is to consistently deliver revenue growth and expanded margins, EPS, and free cash flow. In Q1, we saw resiliency in our business, delivering 4 quarters of revenue stability despite a slowing IT market. However, customer demand for hardware PCs and network devices, along with some project work, has been delayed to the second half of the year at a higher rate than anticipated. Our GBS business performed as planned, delivering solid growth of 3.3% in Q1. GBS represents 49.4% of our overall revenue and has grown for 9 consecutive quarters. We have seen the ability to sell new GBS work to long-standing GIS customers, which provides a source of upside revenue. Our GBS offerings, such as analytics and engineering and insurance, are uniquely positioned in their respective markets and have been our highest revenue growth offerings. On the other hand, our GIS business declined by 9.9% in Q1. Our security offering showed growth, providing valuable resources to help customers protect themselves against security threats. However, our Cloud EDO offering experienced the largest decline. We are actively working to fix our dependency on underutilized data centers, develop a solid pipeline, and move work to the cloud. Our modern workplace offering also declined, but we have taken actions to manage disruption from terminated contracts, improve customer delivery, and enhance our market reputation. We have made measurable improvements by moving to an offering-led operating model, which increases customer coverage and brings the right skills to deliver and win new work. Our AI capability is embedded in both our GBS and GIS businesses, allowing us to lead the market in this area. We have over 10,000 trained AI professionals and AI capability in 4 out of our 6 offerings. These solutions are at scale, enhancing customer delivery and driving new revenue. In summary, while our GBS business performed well, our GIS business faced challenges. We are actively addressing these challenges and making strategic changes to drive growth and improve margins. We remain focused on delivering consistent results and transforming our finance organization to provide more predictable and repeatable financial analytics. Now speaking, Rob Del Bene, Executive Vice President, Chief Financial Officer. In the first quarter, our organic revenue growth was down 3.6%, mainly due to a slowdown in customer expenditures in the resale of IT equipment and project work. This impacted our profitability, particularly in the GIS segment. However, our GBS segment continued to show consistent year-to-year growth. We are focused on reducing resale revenue and driving services revenues in the long term. Expenses were well managed, and our free cash flow was negative $75 million, ahead of expectations. Our gross margin was 21.1%, up 10 basis points year-over-year. Our SG&A spending was down 6.5% year-to-year, and our depreciation and amortization was down 10.5%. Adjusted EBIT margin was down by 50 basis points year-over-year, excluding pension income and asset sales. The EBIT margin is up 60 basis points year-to-year. Our GBS segment grew 3.3% organically and posted a 9th consecutive quarter of organic growth. Our GIS segment experienced an organic revenue decline of 9.9%, driven by declines in cloud infrastructure and IT. In terms of our offerings, analytics and engineering revenue performance was up 8.8%, and security had a strong performance, up 6.8% year-to-year. However, cloud infrastructure and IT outsourcing declined 12.7%, and modern workplace experienced a 5% decline in revenue. We anticipate continued year-on-year declines for modern workplace for the remainder of the year. Our debt levels increased modestly to $4.6 billion, and we continue to manage restructuring and TSI expense. We made progress on our share repurchase program, and we believe DXC presents an attractive valuation. Due to areas of weakness, we are lowering our guidance for the second quarter and full year. We expect second quarter organic revenue to decline between -4.5% to -5.5%, and adjusted EBIT margin to be between 6.5% to 7%. For the full year, we are reducing our organic revenue growth to -4% and adjusting EBIT margin to 7% to 7.5%. Our immediate priority is to produce metrics and analytics to drive predictable and repeatable results. We will align the financial teams to support the offering-led model and make enhancements to our processes and systems. Now speaking, Mike Salvino, President and Chief Executive Officer. GBS is our high-quality growth business that is performing well in a tough project-based environment. We are taking action to improve our cloud ETO and modern workplace offerings, which have been impacted by the slowing IT market. We are confident that we will stabilize the performance of these offerings. We have made improvements in leadership and our operating model to grow our company and be more competitive. We are effectively managing areas within our control, such as free cash flow and restructuring in TSI. Our financial analytics team is focused on building predictability and repeatability in our results. We are creating value in DXC and will continue to deliver on our $1 billion buyback while maintaining our investment-grade credit profile. We believe that our long-term decisions will position DXC for success. Cohen & Company analyst Zachary Zenman inquired, "Can you please explain what factors led to the significant guidance cut in just 2.5 months? Additionally, have there been any changes to the guidance framework due to the lower visibility in the current environment?" Mike Salvino replied, "Our revenue has remained stable despite a slowing IT environment in Q3 and Q4 of last year. This is because the work we do is essential for our customers, leading to continued spending on hardware, PCs, and maintenance projects. In FY24, we expected revenue to stay stable based on these factors. In Q1 and for the full year, our GBS segment performed as expected, and our offerings are also doing well. The challenges we are facing are primarily in our cloud ETO and modern workplace of GIS segments. The decline in revenue in these segments is mainly due to a decrease in low-margin resale revenue, which we are intentionally reducing and replacing with higher-margin service revenue. Additionally, project work has been delayed, contributing to the revenue miss in Q1. However, we anticipate that clients will spend on these projects in the second half of the year. We have also made adjustments to our operating model to improve customer coverage and better sell these projects. Overall, we expect to recover some of the missed revenue in the back half of the year." Cohen & Company analyst Zachary Zenman inquired, "Can you please explain the factors that are contributing to the higher-than-expected free cash flow levels despite the decrease in revenue and earnings? Additionally, could you provide some insight into how you are managing expenses without compromising the company's core operations?" Rob Del Bene replied, "We are confident in our ability to achieve the adjusted EBIT margin of $800 million for the remainder of the year. Our cost reduction plans and operational actions, along with working capital and capital expenditure reductions, support this margin. We have a clear line of sight to deliver on these objectives." Mike Salvino replied, "Our focus on expenses remains strong, and we believe there is further potential for cost reduction. Our cost takeout initiatives are expected to deliver results comparable to FY23, during which we generated $737. This serves as a good guide for our future performance." Deep Dive equity research analyst Rod Bourgeois inquired, "Have you seen any improvement in the cyclical part of your business since the quarter closed, specifically in project-based work and resale work? Does your updated guidance assume that project-based work will improve significantly in the second half of the year?" Mike Salvino replied, "In terms of our resale revenue, we did not anticipate the improvement we saw in Q3 and Q4. However, in Q1, we did not achieve the same level of performance. This is reflected in our guidance, with the majority of the adjustment focused on resale revenue. Historically, we have experienced a decline of around 25% in this area. Moving forward, we will continue to address this challenge throughout the year." Regarding project work, it is not limited to just ETO, cloud ETO, and modern workplace. While we will prioritize project work in these areas, there are other offerings that are performing well and also contribute to project-based services. We anticipate an increase in project work in the second half of the year. Deep Dive equity research analyst Rod Bourgeois inquired, "Did the CFO transition contribute to the guidance reduction and were any lessons learned to better track and recognize challenges in the future?" Mike Salvino replied, "The change in our operating model from a regional to a global offering model had a significant impact on our business in the quarter. This shift allows our leaders to focus on selling all 6 of our offerings, rather than just the ones they are most familiar with. We have seen positive results from this change, particularly in our analytics and engineering, as well as insurance offerings, which have embraced the new model and are driving growth in revenue and margin. Our goal is to replicate this success with our other 4 offerings. While we are still making adjustments, we expect to see benefits from this change in the second half of the year." The softness in project work can be attributed to the challenges associated with implementing the new operating model, but we remain confident in its long-term effectiveness. BMO Capital Markets analyst Keith Bachman inquired, Mike, considering the challenges faced in turning around half of the business, particularly in the struggling workforce management area, have you considered the possibility of divesting underperforming assets to improve the overall financial condition of DXC? Mike Silvino replied, we believe that keeping all of our offerings together is the best approach for our customers. We have seen an uptick in selling new GBS work to our long-standing customers on the GIS platform. Selling off assets may not be the best solution for our customers. We have been actively adjusting our business, including our efforts to sell data centers. Our strong relationship with customers has allowed us to become a preferred partner for cloud providers. We aim to be the partner of choice as customers transition their critical workloads to the cloud. While it may take some time, we are actively exploring other opportunities. Thank you for your question, Keith. Is there anything else you would like to ask? BMO Capital Markets analyst Keith Bachman inquired, in the context of the working capital tweaks mentioned earlier, are you potentially borrowing from next year's free cash flow generation to support the 800 target, rather than experiencing a significant degradation in the EBIT line? Rob Del Bene replied, no, we are not trying to accelerate anything temporarily. Our focus is on operational discipline and achieving sustainable levels of capital savings and receivables over the long term. We believe that operational improvements will benefit us in the future. MoffettNathanson analyst Lisa Ellis inquired, can you provide an update on any strategic or transformational changes that DXC is considering to improve its revenue trajectory? This could include acquisitions, divestitures, or creative client deal structuring. Mike Silvino replied, we have a strategic plan in place for our cloud and EDO businesses, along with our modern workplace segment. We have identified 4 key steps to achieve value in these areas. Firstly, we have successfully dealt with the disruption caused by terminated contracts, and this year will mark the end of the revenue runoff from those contracts. This means that the revenue we currently have is sustainable. Secondly, we have focused on delivering exceptional customer service, as evidenced by our industry benchmark NPS score. This has allowed us to explore additional opportunities with our customers. Thirdly, we have scaled our offshore model for efficient delivery and increased customer satisfaction. And finally, we are only pursuing deals that offer solid economics, ensuring the financial health of our business. By following these steps, we have positioned ourselves as an attractive partner for cloud hyperscalers. Our next focus is on migrating essential work from our data centers to the cloud through strategic deals, which will further strengthen our GIS business. Despite the challenges we have faced, we believe we are in a favorable position. Our resale revenue has been declining over the past 3 years, and we expect it to be below $1 billion in FY24. This means that the revenue we report each quarter will be of higher quality and allow for better margins. MoffettNathanson analyst Lisa Ellis inquired, could you provide more details on the current AI initiatives at DXC? Are these initiatives focused on internal operations, or are you also engaging with clients on their AI strategies? Mike Silvino replied, our focus is on driving revenue and showcasing our capabilities beyond GIS through our GBS business. Let's dive into the 4 offerings mentioned on the call. First, DXC Assure is a market-dominating play in the insurance industry. With 18 out of the top 20 insurers as our clients, we continue to innovate and provide solutions for their complex insurance questions. This tool generates revenue and enhances customer retention. Next, robotic drive positions us as leaders in the self-driving vehicle wave. Our AI technology enables cars to drive autonomously and provides facial recognition to assist human drivers. This showcases our engineering talent and drives revenue. In GIS, our AI capability is exemplified by Platform X. This cutting-edge tool replaces outdated monitoring tools on IT estates. With AI, we can detect and resolve issues by launching one of our 10,000 bots, minimizing human intervention. Clients love this solution, and it contributes to revenue growth. Lastly, Uptime is a powerful tool that deflects up to 80% of call center volume through AI agents. It also predicts PC failures and helps customers manage their carbon footprint, aligning with ESG goals. Uptime is a valuable offering that drives revenue and enhances customer satisfaction. We are confident in our ability to lead the industry by focusing on scalable solutions that provide value to our customers and drive revenue. While it may take some time, we believe we can improve performance in GBS and increase services revenue in the GIS business. Thank you for attending the call.